Welcome to the deep dive. This is where we take all that information swirling around out there, grab the important bits, and basically hand them right over to you.
Yeah, think of it as your shortcut to being well-informed. We try to find those surprising facts, maybe add a bit of humor, keep things interesting.
Exactly. You give us the sources, we do the digging, you get the insights efficiently.
And today we're diving into auditing. Specifically, we're working from excerpts provided by one of you from Charles B. Hall's The Why and How of Auditing. Auditing Made Easy.
Right. Our listener, like I think many of you, wants that solid knowledge quickly, wants the different angles, those aha moments, but without, drowning in data.
So this deep dive is that shortcut for understanding the core ideas in Hall's book about auditing.
And what do these excerpts cover? It looks like the whole process, really.
Pretty much. From the get-go planning, risk assessment, fraud considerations, all that.
Right.
Then into the nitty-gritty of actually auditing specific accounts, cash, receivables, investments, property,
The big ones.
payables, payroll, debt, equity, yeah. And finally, how to wrap it all up correctly.
And Charles Hall, the author, he's not just theoretical, right? He's got real-world experience.
Oh yeah, 34 years as a CPA. Auditing all kinds of entities in the U.S., so he's writing from that practical U.S. GAAP perspective.
Yeah, being generally accepted auditing standards.
Generally accepted auditing standards, yes. And his goal isn't some exhaustive textbook. It's more like making it understandable, concise, practical.
Good, because auditing can sound dense.
It can be. And other CPAs seem to agree he pulls it off. James Bennett, Jamie Aki, Jacob Gatlin, Armando Balbin, they all praise the book's clarity on complex stuff.
Saying it's useful in practice, like
Yeah.
the questions to ask, the steps to
That's
take.
exactly real-world application.
Now, Hall mentioned something in the preface, a pain point for auditors.
Yeah.
The embarrassment of peer review findings,
Yeah.
especially about planning and risk assessment documents.
Right. It's that struggle to find the just right amount of work. Not too little because, well, peer review.
Right, scrutiny.
But not too much either because that's just wasteful. It's inefficient.
And that feels relatable, even outside auditing, getting that balance right.
Yeah.
Avoiding overwhelm, but still being thorough.
Absolutely. And Hall structures the book around three main areas to tackle this. Planning.
Which includes things like deciding whether to even take on a client.
Yes, acceptance and continuance. Crucial first step. Then risk assessment, fraud, and the actual audit plan.
Okay. Planning first, then.
Then, performing the audit, actually testing those specific account balances we mentioned.
Cash, receivables, etc.
And finally, completing the audit. Wrapping it all up.
Okay, let's start with that first one then, client acceptance and continuance. Hall says it's maybe the most important step. Seems foundational.
It really is, though sometimes overlooked. It dictates everything that follows.
I was thinking about my daughter's early online dating disasters, and you wouldn't just dive into a serious relationship without knowing anything about the person.
That's actually a great analogy.
You check him out, right? Background, intentions.
Exactly. Same idea for auditors and clients. You need to vet them before you commit. And keep checking in on existing relationships, too.
So it's not just about getting new business.
No, Hall talks about a win-win philosophy. It has to work for both sides. Protects the firm's reputation, too, avoiding difficult or unethical clients.
And capacity is a big piece of this. Can the firm actually do the job properly?
Right. He gives that example. A firm's already swamped, gets offered a new job with a crazy deadline. Tempting fee, maybe?
But taking it on could be a disaster if they don't have the time or people.
Precisely. It compromises quality. So you ask questions up front. What's management's experience? Why are they switching auditors if they are?
Red flags might pop up there.
Could be. And you keep that documentation. It feeds right into planning the audit later if you do take them on.
So key takeaways for acceptance. Avoid dodgy clients.
Definitely. Ensure independence. That's non-negotiable.
And be honest about your own ability, your firm's ability to do the audit, technically, resource-wise.
Yeah. Get that wrong up front, and you're asking for trouble.
Okay, makes sense. Now, risk assessment. Hall calls this the auditor's best friend for efficiency and effectiveness. Sounds important.
It absolutely is. It's essentially the roadmap. Tells you where the dangers might be, where to focus your energy.
And critically, maybe what you don't need to spend as much time on.
That's the efficiency part. But here's the thing. Hall says some auditors actually shy away from it.
Really? Why? Seems counterintuitive if it helps so much.
Could be they don't fully grasp it, or maybe they just fall into routines, creatures of habit.
The Saley approach, same as last year.
Exactly, a Saley. But Hall asks, what if last year was flawed? Just repeating it doesn't make it right.
Good point. Like driving the same route without checking if there's construction or a faster way now.
Precisely. The proper flow, according to standards, is assess risk first, then plan based on that risk, then do the substantive work, then form your opinion.
But some work backward, do the work, then sort of
Yeah.
backfill the risk assessment paperwork.
Unfortunately, yes. Just ticking a box. It defeats the whole purpose.
So how do you do it right? Starts with understanding the company.
Absolutely. Understanding the entity and its environment is foundational. Hall has this great magic wand question he suggests asking management.
Oh yeah, what's that?
If you could wave a magic wand over the business and remove one problem, what would it be?
Huh. That probably tells you a lot. Gets right to their biggest concerns.
Exactly. Often points directly to the biggest business risks, which frequently link to where financial statements might be misstated.
And there are other questions too, right? About the industry, competitors, suppliers.
Yeah, all that external context. Plus internal things, cash flow pressures, debt load, market share, key staff, their strategy, any related party dealings.
Yeah.
You need the whole picture.
Okay, so you gather all this info about the business risks. How does that translate into, like, audit risk?
You connect those business risks to the potential for material misstatement in the financial statements. Is there pressure to inflate revenue? Is inventory valuation tricky? That kind of thing.
And the response depends on how bad the risk seems.
Right. It's tiered. Some risks might affect the financials overall. You address those broadly. Others affect specific transactions or accounts. You target those with specific procedures.
And understanding their internal controls is key here too. Hall mentions walkthroughs.
Yes, walkthroughs are probably the best way to really see how controls work in practice. You trace a transaction from start to finish.
So you'd actually, like, follow an invoice through the system.
Exactly, and ask questions along the way. For cash, for instance. Who signs checks? Who can approve electronic payments? Who reconciles the bank account? Is there segregation of duties?
So if only one person handles everything for cash, that's a weak control.
Big time. That's a risk indicator right there. Weak controls signal higher risk.
And it's not just paper anymore. IT controls are huge.
Crucial. You need to understand both application controls specific to software like accounts payable.
Like the three-way match. Invoice, purchase order, receiving report.
Precisely. And also, general IT controls the overall environment. Things like passwords, how software changes are managed, physical security, backups, antivirus, firewalls.
Phishing training. Cloud security. Who has access to what?
All of it. Even the expertise of their IT staff, or if they outsource it, then you might need SOC reports from the service provider.
Wow, okay. That's a lot on the control side. What other tools for spotting risk? Hall mentioned planning analytics.
Right. Basically, comparing numbers, looking at trends over several years, calculating key ratios.
And if something looks way off compared to last year, or the budget.
That's a signal. Could be an error, could be fraud, needs investigation. It's about having expectations based on understanding the business, then seeing if the numbers match.
And fraud specifically, auditors need to ask about that too.
Definitely. Make specific inquiries about fraud risk. Consider management override the risk that managers bypass controls. And especially the risk of intentionally overstating revenue. That's a common one.
But it's not always fraud, right? Sometimes it's just mistakes.
Absolutely. Especially in smaller clients, Hall notes, sometimes the bigger issue is just the same old errors cropping up year after year.
So maybe keeping track of past adjustments helps.
Yeah, he suggests maintaining a summary of larger audit entries from prior years. Helps spot those recurring issues.
So it's like assembling a puzzle. You take the control weaknesses, the weird variances from analytics, the business risks, related parties, potential theft.
And you put it all together to create the risk picture, as Hall calls it. That overall assessment of where things might be materially misstated, the RMM.
RMM, risk of material misstatement.
Exactly. And that picture dictates your audit strategy, the overall approach, and your audit plan, which is the detailed list of procedures, the audit programs.
Got it. So summarizing risk assessment, crucial tool, got to do it before detailed planning, use lots of inputs, understand the business, walkthroughs, analytics, fraud questions.
Understand the entity and its controls.
Right. And then build your strategy and plan specifically to address those identified risks.
Couldn't have said it better. That's the core idea.
Okay, so that's the planning and risk foundation. Now let's dig into performing the audit on specific areas, starting with cash. Seems straightforward, but maybe not.
Well, yes and no. It's often where theft happens, so controls are critical. Hall warns that even standard procedures like bank recs and confirmations aren't foolproof. There have been frauds with fake documents.
So controls are key. What kind of questions?
Who reviews the bank reconciliations? Are all bank accounts actually on the books? How do they handle cutoff at year-end? Crucially, segregation of duties, who handles cash versus who records it.
Who can open or close accounts, sign checks? Any restrictions on cash?
Exactly. And how are deposits handled? Are checks ever held instead of deposited promptly? The directional risk is usually overstatement, trying to make cash look better than it is.
But theft is a big risk too. Or just errors in the reconciliation.
Right. Primary risks.
Right.
Theft, intentional overstatement, maybe hiding accounts, simple errors in the reconciliation or cutoff.
So besides confirming balances and testing the bank recs,
You'd vouch reconciling items, trace them to supporting documents. Definitely inquire if all accounts are listed. And inspect transactions right around year-end for proper cutoff.
okay? How about receivables and revenue? Often linked, often a big focus.
Very big focus,
Yeah.
because management often has incentives to boost revenue figures.
Right, make the company look better.
So the key assertions auditors worry about are existence, do those receivables actually exist? Occurrence, did those sales actually happen? Cutoff, are they in the right period? And valuation, are the receivables likely to be collected?
Completeness and accuracy matter too, but those first few are often the big ones for revenue receivables.
Generally, yes. Existence, occurrence, cutoff, valuation. Directional risk is almost always overstatement.
Makes sense. And controls, what do you look for?
How do they reconcile the detailed customer accounts to the main ledger? What's their process for estimating bad debts, the allowance? Who approves write-offs? Do they review aging reports? Crucially, revenue cutoff controls.
Segregation of duties again,
Yeah,
billing versus collections.
definitely. What software do they use? Is revenue recognition complex? How is it documented and followed?
And substantive tests. Confirmations are big here, right? Sending letters to customers.
Yes, confirmations are a standard procedure. Also, looking at cash collected after year-end to see if those receivables were real. Reviewing how they calculated the allowance for doubtful accounts.
Comparing margins to prior years. Looking for unusual trends.
Exactly. Analytics are key here too, analyzing revenue per customer, things like that.
All right, next. Investments. Hall says this can be simple or really complex.
It really depends on what they're investing in. Simple stocks or bonds, maybe just confirm the holdings. Complex derivatives or private equity, much harder.
So understanding the nature of the investments is step one.
Absolutely. That dictates the whole approach. Key assertions are similar. Existence, accuracy, valuation, which can be the tricky one, cutoff, completeness, directional risk, again, usually overstatement.
Control questions would focus on what types of investments, anything unusual.
Right. Do they need specialists to value them? How are they classified on the balance sheet? Does the accounting staff understand the rules? Are they reconciled regularly?
Who has authority to buy or sell? Are there restrictions? And investment policy.
All good questions. Plus, how do they handle potential impairments? Who's responsible for ensuring disclosures are right?
Substantive procedures then. Confirm holdings.
Yes. Inspect cutoff. If valuation is complex, auditors might need to bring in their own specialist.
And really check the disclosures against the accounting rules using, like, a checklist.
Definitely. Disclosures for investments can be very extensive and complex.
Okay. Property, plant, and equipment, PP&E. Often a huge number on the balance sheet, but Hall says risk is often low to moderate.
Yeah, it's large, but transactions might be infrequent compared to sales or cash, and it's harder to, steal a building.
Fair point. Directional risk is overstatement, like capitalizing costs that should be expensed.
Exactly. Or inflating values. Control questions focus on what's their capitalization threshold? Do they have a policy for bids on large purchases? How are disposals handled? Is the depreciation schedule reconciled to the ledger?
Primary risks being overstatement, improper capitalization, maybe incorrect depreciation, theft of smaller, movable assets.
Kickbacks on purchases could also be a risk. Substantive tests usually involve vouching additions, looking at invoices for major purchases.
Agreeing the beginning balances to last year's audit.
Right. Reviewing depreciation methods and useful lives for reasonableness. Maybe calculating depreciation expense as a ratio to see if it makes sense. Inquiring about impairments.
Got it. Now, shifting gears. Payables and expenses. Risk of understatement here.
Yes, that's the big one. Companies might be tempted to delay recording expenses or liabilities to boost profit, plus potential for theft through payments.
So directional risk is understatement. Controls are crucial. Cutoff procedures again.
Very important for payables. Also, purchase order authorization. The three-way match we talked about. How do they mark invoices as paid to prevent duplicates?
Purchasing policies, credit card controls, bidding requirements, who approves payments.
Check signing controls, electronic payment security, segregation of duties between purchasing, receiving, and paying. Vendor setup controls, preventing fake vendors.
Travel and entertainment policies, who reconciles bank statements.
All relevant controls. Primary risks. Intentionally understating liabilities, payments going to the wrong people, duplicate payments, inflated amounts or kickbacks, not following bid policies.
And the big substantive test here is the search for unrecorded liabilities.
That's a critical one. Looking at payments made after year-end to see if they relate to the period being audited. Also detailed expense analysis looking at aged payables for any going concern red flags.
Makes sense. Payroll, often a huge expense.
Usually one of the biggest. Directional risk is typically understatement of the expense or related liabilities, but overstatement can happen with fraud, like ghost employees.
Control questions cover the whole process: hiring, firing, pay rates, processing payment.
Pretty much. Who authorizes hiring, firing, what paperwork is needed, is there budgeting, and how is actual compared to budget? Controls over checks or direct deposits, approvals for overtime or large bonuses.
Compliance with payroll laws, segregation of duties. How are employees moved from the system? Who controls master pay rate files?
Controls over benefit accounting pensions, post-retirement benefits can be complex, reconciliation of withholding accounts, any capitalization of payroll costs, surprise audits, outsourcing.
If they outsource payroll, do they get a SOC report?
They should, ideally. Primary risks. Understatement, payments to fake or terminated employees, duplicate payments, improper accounting for benefits.
Substantive tests, reconciling payroll expense to the tax forms like the 941s.
Yes. Analytical review, does the total payroll expense make sense given headcount changes? Recomputing accruals for wages or vacation. Reviewing withholding accounts. Comparing to budget prior year.
And specific tests if controls seem weak, or for complex areas like pensions.
Definitely. Testing those requires specialized knowledge sometimes.
Okay, nearly there. Debt can be simple, like a bank loan, or tricky.
Yeah, classification issues current versus non-current. Embedded features. Leases that should be recorded as debt. Directional risk is understatement hiding debt.
Controls. Who authorizes new debt? What are the proceeds used for? Is there collateral? Are terms being tracked? Covenants?
Is all debt actually recorded? Are issuance costs handled correctly? Any guarantees? Letters of credit?
Primary risks. Hiding debt, misclassifying it, not recording leases properly.
Right. Substantive tests involve reading the agreements carefully, summarizing and testing compliance with covenants, reviewing new leases.
Confirming balances and terms directly with lenders.
Standard procedure. Determining proper classification. Agreeing the letter to amortization schedules. Checking interest accruals and future payment schedules.
And finally, equity. Usually easy, but sometimes not.
Usually less risky, fewer transactions. But complex equity instruments exist. Stock options, different classes of shares. Primary assertions are existence, occurrence, rights, obligations, classification.
Control questions depend on the entity type, right? Corporation, LLC.
Yes. What types of equity exist? Authorized versus issued shares. Convertible debt. Dividend history. Accumulated other comprehensive income. Ownership records. Reviewing minutes for approvals.
Any attempts to raise capital. Non-controlling interests. Stock compensation plans. Restricted funds in nonprofits or governments.
All relevant depending on the entity. The main risk is often just the auditors not having sufficient knowledge of complex equity or the specific reporting framework.
Substantive tests. Basically review everything that happened in equity during the year.
Pretty much. Summarize and review all transactions. Check classification. Agreed beginning balances to the prior year. Review disclosures carefully.
Okay. Wow. We've really covered the audit process from planning through performing tests on major accounts, all based on Hall's insights.
Yeah, it's a journey from that initial client assessment right through to the detailed testing.
So, as we wrap up this deep dive, what are the big takeaways? We didn't explicitly cover the completing phase much, but it involves final checks, right?
Right. Completing involves final analytical reviews. Does the whole picture make sense? Looking at subsequent events, things happening after year-end, getting management representations, written confirmation from them, and then finally issuing the audit opinion.
But the core message running through Hall's approach seems to be understanding the why.
Exactly. It's not just robotic checking, it's risk-based. Thinking about what could go wrong, where the incentives lie, potential for fraud, and tailoring the work accordingly.
This overview gives a good sense of the principles, the complexity, and what goes into trying to ensure financial statements are accurate.
Hopefully provides that foundation our listener was looking for.
And for you, listening in, maybe you got that efficient, thorough knowledge boost about auditing fundamentals.
And perhaps a final thought to leave you with. How could these ideas, risk assessment, understanding processes, looking for potential misstatements, apply in your own world?
Even outside finance.
Absolutely. Thinking about risks and controls, understanding how things are supposed to work versus how they actually work, that's valuable in almost any field, wouldn't you say?
Definitely something to chew on.
Yeah.
And if this dive made you curious, check out Charles Hall's book for more detail. This was really just scratching the surface.
Indeed. Thanks for joining us for this deep dive.